morning. So for those of you who don't know me, my name is Bill Spaniel. I'm the head of bank supervision and regulation here at the Federal Reserve Bank. And I'm probably the guy that would say methinks they does protest too much in terms of regulation around fintechs and a level playing field. But that's my job as a supervisor. I'm paid to be a skeptic. But today I think we're going to have a really good conversation about what the future of fintech regulation should look like, how far along that path we may actually be, how well equipped are we, particularly at the state level, to actually deal with these types of products and services and emerging technologies, and then I think a view of what more we might need to do from a regulatory standpoint. So I'm very happy to have the panelists we have here today. John Ryan is the CEO of the Conference of State Bank Supervisors. Aaron Klein is a fellow in economic studies at the Brookings Institution. Richard Herring is a Jacob Safra Professor of Banking at the Wharton School. And then Richard Neiman is the head of public policy at LendingClub. So I think we have a wide representation to have this. We're going to start it by having John make some comments on the state of regulations, particularly as it applies at the state level, where we do have a few sandboxes and we have some innovation. We'll then come back and have some questions to the panelists about, are we far enough along in the regulatory standpoint? Are we prepared for this? I think based on the conversations yesterday, are enough conversations occurring about what regulation should look like going forward? And then what is the role that regulators maybe should play going forward, and how far along with that? So without further ado, let me introduce John.
So it's really challenging following this morning's discussion, and I feel like maybe I'll just be digitized and vaporized right here and now, and we won't have to worry about all of our 3D problems. But we do, and we do have a system, and I just want to give you a little bit of a sense of kind of where I come from and what I represent. But we do have a system of federated government in the United States, and I represent a part of that federation. And I'd like to discuss how that's evolving, the role that we see of the states, and start with a premise that we shouldn't, a lot of this discussion gets characterized as state or federal. I think as we look at all these challenges, it has to be state and federal, and that there's a recognition of the roles. And so I'll be emphasizing that I believe there still is and should be a role for the state in this federated system of financial regulation. So first, while my name up here, Conference of State Bank Supervisors, was an organization that's been around since 1902, before the Fed was created, or the FDIC as state regulators, but after the creation of the comptroller of currency, state regulators were, along with our federal counterpart, struggling with a series of economic challenges, to say the least, and a need to professionalize financial regulation. So that was in our roots. These agencies have evolved at the direction of state legislatures to be more than the chartering of insured depositories. They also are the licensing authority for principally two other areas of financial regulation, but it can be much broader than that, among my membership. And that's payments and lending. So the payments and lending that occurs outside the banking system. And that's where a lot of the action is. It is also around the deposit-taking side, but the holding of funds, the payments of funds, and the lending of funds. So that's where I'm coming from. We're chartering authorities, and we're licensing authorities. And I'd love in our pre-call, Aaron had some really interesting comments on the history of chartering and licensing that I think are helpful to this discussion. I also want to hit on some of our principles as we've evolved and think about what is our role? What makes us necessary? Are we still necessary as participants in the financial regulatory system? So I'd list off the three things that really drive us. First is and this is the part of why we have a federated financial system, it is access to financial services, a range of financial services in a variety of markets across this country. Urban, rural, the whole really trying to work towards a more inclusive financial system. That's at our roots. How we've focused on getting there is facilitating market competition, new entrants, smaller entrants in the financial system. Also, what's become a newer, more driving thought process, very much influenced by the financial crisis, is that we believe we have a responsibility to continue to facilitate that innovation and not necessarily force everything into the bank model, not erode necessarily the bank model, which has given a lot of confidence in our financial system, but also not force everything into the safety net, as we realize, one, the risks that can pose to the financial system. If everything's in the safety net, it does tend to concentrate more power. It raises the barriers of entry and starts to limit competition. And last but not least, enable market competition and innovation based on strong consumer protections. That's a fundamental in our discussions. So what we look like right now, the state system, on the banking side, it's 79% of charters, but around 30% of the assets of the system, as we've seen a lot of consolidation into the largest national banks. They're still very relevant players in a variety of different ways, particularly around smaller customized commercial lending. Significant source of commercial lending despite their size, so an outsized performance around small business. But we obviously see some new competitors in that market. The states also license the rest of the financial system. My piece, as I said, payments, lending, some around debt collection, but the states also have insurance and securities. To give you a sense of what some of the licensing looks like in the mortgage industry, we just had a summit yesterday, a day before yesterday in Washington on the mortgage industry. So about half of mortgage origination, and it's growing, is now in the non-bank sector. $890 billion in annual originations and $3.9 trillion in servicing. So a lot of growth in that part of the non-bank market. Money services also growing, 1.4 trillion annual transactions. So again, a mandate around these non-bank areas of safety and soundness and consumer protection. Talking about, this is where the innovation comes in, and this is part of this discussion of the state and federal and what's going to best facilitate innovation. And I think we have to think about this together as a financial ecosystem and quit the sort of combative approach about, we're more innovative, you're more innovative. But this system of allowing the lower barriers to entry of licensing than chartering have allowed for a lot of innovation. Our mortgage origination market demonstrates that. So it's moved from 2013 from 1/3 of the market to now 2/3 actually of originations in mid-2019. The servicing was 2011, it was 6%, it's 27% in 2014, 48% now. MSB, fintechs, and we define those as those without the old Western Union model of the physical agent, so completely online, 22% to 75% is purely online now in the MSB world. And that now represents the model about 53% on all volume. So where do fintechs fit into the state regulatory model? It's been challenging. I'll admit that. We have a system of 50 states that was based on that 3D world physical presence, and we're working our way through that. The fintechs have forced us to face some of those challenges much more quickly than we expected, and we're adapting. We were frankly better positioned than we would have been because of the mortgage crisis that we started to experience in the early 2000s. We saw a need to create a network of supervision and not a siloed system of 50 states, and use technology to do that. The states created a platform that CSBS provides that now creates that network of supervision. And gave us a frame of mind and to be able to respond to a digital marketplace with a more digitized system of supervision. We do not focus on technology per se, fintech, non-fintech, as a rule. That was one of the early questions. Is there something so fundamentally different about a fintech model that we need to fundamentally rethink supervision? And our initial answer is no, not necessarily. So let's start with what they're doing. And we are focused based on the activity. So if you're conducting money transmission online, it follows the same rules that it followed in the 3D world with maybe some exceptions. Particularly if you're in consumer lending, if it's the same sort of activity, when we get down to the essence of it, then we're following the same rules. That challenges us as those rules differ across jurisdictions, but we're effectively following the same rules. The same is true for mortgage lending and other things. So we have taken an activity-based approach to a lot of this. While existing laws can address much of fintech activity, there still are gaps in our regulatory process with new business models, distribution channels, where regulators need to understand and get more information. Obviously, some of the discussions that we've heard today, blockchain and digital currencies have challenged some of our thinking, and states are responding in different ways to this. But for the most part, we think things still fall into the activity basis. What I think is fair, and we should have more discussion, is that narrower activity focus hasn't always taken a holistic view of the company, the provider, and there may be some needs for us there depending on the activities of the company. For efficiency, and this is where we have been pushed as a state system, and I think appropriately to respond to a more digital financial system, is how we work together. And as I said, it's through this network that our platform, our technology platform, provides. And we've been, I am now effectively heading a tech company as much, if not more, than a traditional regulatory policy company. Organization. We are affecting probably more policy change through our adoption of technology than we are through advocacy on Capitol Hill or with our regulatory partners. So all states, all 50 states, use the system that we've developed. 44 states and trending to probably all 49 states that regulate money transmission in the near term. So 44 presently, 33 for consumer finance. Federal regulators use our system for the mortgage industry, and we've created MOUs and information sharing around the non-bank mortgage space, and where we collect a lot of data, and now on the MSB space, and we're presently developing, in the language of bank regulators, a call report for consumer finance. So we are creating this digital system of regulation, this platform, that can help us, I think, still preserve our essential values. I want to kind of cut to the desire of fintechs and the pressure that we felt in this space for a more seamless system, and those who are looking to scale quickly, how we've responded. So that's encapsulated, if anyone wants to look at what we're doing, in something that we called Vision 2020 of 5 years ago or 4 years ago when we named this. I knew 2020 would be here so quickly. I might have called it 2025, but we have achieved actually a lot since we set out to do this, and certainly a frame of mind that really all the regulators that I represent now have. The goal of this was to better harmonize the state system so we could preserve those essential values, which were that accountability at the local level. I think this is something we all need to think about, and the last two panels have me thinking about this a lot. Where is the accountability? We have lots of agreements. We have, a federated system in the EU. We have a federated system in the US. Canadians have a federated system. How do we preserve a sense of the public, confidence in institutions, and accountability to them? And we see ourselves in this role, and if we want to preserve that, then we better respond, innovate, and modernize. So as a part of this Vision 2020, we established a FinTech Industry Advisory Panel. Our focus was to understand the pain points for those new emergent participants in our marketplace, to get their industry input in their context. And out of that came a report which they produced. I was very proud of my members that they gave up control and allowed a group of industry participants to tell us what they wanted rather than us filtering through that. So they presented 19 recommendations. Our board, our members adopted 14. We are acting on them now. We're tracking them. You can see that this results in multi-state agreements. So instead of individual licensing, coming together in ways to license companies, multi-state supervision. We've just launched, we're piloting a digital platform of supervision for the 50 states that allows information sharing, standardization of supervision, a real modernization of our infrastructure. So that's going into effect next year. And we've been focusing on areas where we thought standardization was either most easily achievable, so we could build on success. I heard the discussion of small experiments. That comes now heading a company that's involved in technology. I understand agile and small experiments and all of this. So the small experiments, so we started with a small experiment around interstate agreements. We started with some small experiments around supervision. We're starting with some small experiments around model law. So we've developed model law around MSBs. Another area we focused on is cybersecurity does not know state boundaries. We need a holistic view of cybersecurity for those we regulate. So that's where we get past the activity somewhat into the company level. To sum up, we are enthusiastic. We are sometimes skeptical, but we are enthusiastic about the transformation that technology is providing to our financial system for some of the reasons that you've heard, I'm sure, over the last couple of days. The possibility of creating greater access, greater customization, greater innovation that helps the financial well-being of our citizens, our communities, and our economy. And we want to enable that, but we want to do so in a way that balances out the state and federal and maintains a certain amount of accountability. So, thank you, and I look forward to our discussion.
Thank you, John. So I think what I'd like to do is give each of the panelists an opportunity to respond to this supposition. So if we listen to John, and if we listen to the last few days, while slow to the market, maybe kludgy, maybe requiring much more conversation than anyone would like, I think you could posit that the regulatory structure at the state and the federal level is responding and can adapt to what FinTech is bringing us. So I guess what I'd like to say is do people think that is a reasonable statement? And can the current regulatory structure, although it's fragmented and federated that we have, really provide for this transition or the innovation? Or are there gaps, particularly in places where we're concerned with either the safety and soundness of new entrants, the consumer protection, and the competitiveness? I think if you listen to John, we as regulators are adapting, we are talking, we're thinking about how this goes on. There's a number of forums to have conversations. My first is that sufficient in this environment, or should we be doing something different?
It is deeply insufficient. It is striking to me how the conversation that's been laid out has supposed and ignored the reality and the plight that about 40% of Americans face, maybe 50 or 60 who touch the zero lower bound of their bank account, and ignored the growing role of the payment system as a massive redistribution of wealth from low-income people to the wealthy. Everybody in this room makes thousands of dollars a year tax-free off the payment system. covered by billions of dollars a year paid by lower income individuals. And it's just kind of unsaid. Real-time payments offers the single best opportunity to address some of these core problems. England had real-time payments when the first iPhone came out. Brazil, Mexico, Poland had it before that. I'm old enough to remember when the Federal Reserve said we were going to have faster payments by real-time payments by 2020, per John's comment. In 2014, that sounded like quite a bit of runway. We actually have a real-time payment system the private sector has built because they don't want to be the taxi cab medallion in an Uber story that Gary kind of pointed out. And the Fed won't make their real-time gross settlement service 365 to allow a private sector solution to innovate with that. I mean, who here has been to Wendy's? Who here has been to Taco Bell? Wendy's plus Taco Bell's in America, 13,600. There are 14,000 check cashers in America. 1 out of every 10 swipes is a prepaid card. There's a whole alternative world. $34 billion a year is spent in overdraft. I'd ask in the regulatory system to the two regulators, and if every single bank's overdraft fees went to zero, how would it affect your camels? And if a bank's earning model is predicated on overdraft, if that's their core to their earnings, is that's the difference between a Camel 2 and a Camel 4, what is that institution? And why do we have that institution? So I think there's been a whole lacking of understanding, prioritization on both the safety and soundness side and on the consumer protection side, and frankly on the income equality and growth side in this world, because the world works really well for everybody in this room, and particularly for the financial institutions that benefit from overdraft, which is a huge group.
So when you ask about what type of regulatory system framework should we have to respond to fintech, I often compare some of the how other countries have dealt with it. And a good example is the UK. So the UK developed a new regulatory framework to address fintech lending. It includes incentives to promote innovation in fintech lending, and even includes investment by the government. In the US, we have taken a very different approach. We're shoehorning our regulatory framework into our existing federalist dual banking system, which did not contemplate in any way this national technology delivery system nationwide. Remember, our dual banking system was based upon a time when banks, when states chartered banks that could only lend to residents within the state. They could not operate branches outside of the state. And we have a very different environment now where financial services are delivered without state boundaries. And we've been forced to shoehorn our existing framework. We've adapted to it. You have two different models that have evolved. A direct lending at the state level subject to state supervision, and you can envision the complications of a 50-state model where there are very different requirements at the state level. And the second model is the issuing bank model, one that we at LendingClub use, where all our loans are originated by a federally insured, in our case, state-chartered bank, and we are subject to all of the panoply of regulations, both on the consumer and on the AML side, because we act as a third-party service provider for that bank. So, are there additional, levels of clarity and guidance? Yes, but we are currently all operating under an existing system. We're working closely with John, and I really commend the CSBS. I started my career as at the OCC in the law department and served as a state regulator. I was a member of the board of CSBS for a number of years, from 07 to 11. So I'm very sensitive to the important role that states play. And we'll talk about it. I think states could even be more innovative with respect to fintech. They could be having a much greater effort on harmonization, and we're working closely with the Vision 2020 task force. So I'm looking forward to engaging directly, particularly as we talk about issues around national charters and the role of the states.
Quite sure how this works. Is that?
Yes.
It's on. Thanks. I think the chairman of the FDIC summed this up rather nicely, and I'm paraphrasing her here, but I think it caught the essence of the problem. We're confronted with 21st century technology, which in many ways is absolutely astonishing in its ability to piggyback on an internet system that's fast and ubiquitous and can actually leap over what used to be requirements for bricks and mortar and used to require huge expenditures to reach customers, can now be done very rapidly and by new entrants. And it has certainly posed a number of challenges to the existing structure. Her observation was we've got this 21st century technology, by and large managed by people who were educated in the 20th century, that is structured around regulation, much of which emanates from the 19th century. And there's some obvious mismatches, not least of which is the one you pointed out, that the geography-focused regulation doesn't make a lot of sense when you're dealing with a product that's inherently unbounded by geography. And so the result is we've had to try to shoehorn the kinds of innovation that are taking place into the existing models. And frankly, the Conference of State Banking Supervisors have been, I think, probably the most innovative part of the system in terms of trying to accommodate it. But it is not clear that we have either we yet have the kind of harmonization you need to scale up and actually take advantage of the technology, or indeed that we have the kinds of licenses that are appropriate for the new sorts of businesses that are being developed. You might want to step back and pose the question about why would we even want to regulate fintech? It's certainly a good place to start. Partly it's consumer protection, and that certainly is a heavier burden with regard to retail financial services, maybe less so with regard to wholesale financial services, although you can always raise questions about backdoor retailization. By and large, I think we do have a fairly strong way of looking at consumer protection. Safeguarding the integrity of the financial system is yet another motive. Not so sure that we're doing that quite as effectively. It is true that know your customer rules and anti-money laundering is now extended to a pretty broad range of entities, but I think there are real questions about the intensity with which those rules are enforced outside the heavily regulated system. The other sort of problem would, of course, be the safety and soundness of the financial system. Yesterday, we did have a bit of discussion about that. It usually is associated with size, and so far, none of the fintech firms have reached that kind of size. But one can imagine that given the natural economies of scale and scope, that service providers could reach a position where they become systemic simply because all of the major players are relying on them. It could be like the Bank of New York Mellon situation where, since they're doing all the processing for tri-party repos, they are systemic. There's no getting around it. And that certainly is possible. The other kind of concern that justifies regulation occasionally is monopoly power. Again, you usually associate that with size. It so far, I think, is not a compelling motive to regulate, except you can imagine with the entry of big tech, and I think Gary's point about everybody who does messaging wants to get into the system, you could end up with a situation where you would be concerned about monopoly power because the big tech firms that have masses of information want this source of information, and they can monetize it in a way that is not available to banks for a lot of different reasons, not least of which are regulatory reasons, that very much control the way in which they can use information. So you could imagine a situation where they could use the benefits of the information they gather to basically subsidize banking services or financial services of various sorts and get very, very large shares of the market. So that, I think, is a future kind of concern. But it suggests that there are lots of dimensions that may go well beyond what a state supervisor can look at. And we're trying to shoehorn all of this into the current regulatory structure. So we have the state licensing that goes on, where I think most of the innovation is actually happening. And I think it's terrific that there is an attempt made to make it easier to coordinate across states. The OCC tried to float a special purpose charter, which so far has been thwarted by the courts, who take a very narrow view of their chartering authority, may or may not stand. There is another avenue through the ILCs that have most prominently in Utah, but a couple of other states as well, where you can get FDIC insurance. And depending on what the FDIC decides to do with the Square application, you may see a number of fintechs trying to take that route as a more flexible way in. The Fed could change the game by deciding to open up the payment system to non-banks. And if I didn't misinterpret the president of the Chicago Fed, Evans, yesterday, he seemed to not rule it out, although he certainly didn't say it was a coming thing. That would radically restructure things. But we don't really have a federal way of dealing with this, because even though many of these issues, cybersecurity probably most prominent among them, but many of the other issues really do have at least a national scope to them. So sure, we're adjusting, but I think it's too slow and maybe not very thoughtful given what's happening in the underlying technology.
So let me, at this point, open it up for questions from the audience. We'll take a few questions from the audience and then see what's next on the agenda. Yes, sir.
I'm Ethan Jackson, Federal Reserve Bank of Michigan. I've got a question for Mr. Klein for the institution around competitive environment and consumer approaches. I think something that has been kind of glossed over in this conference is investment in digital infrastructure. And while I really appreciate a lot of the comparisons to other federated countries with similar central banks, it does seem like they work well, especially with their government, to push that digital infrastructure investment. For me, I compare that it was easier to get cell phone service in Tanzania than in Appalachia, West Virginia.
Yeah.
Thank you, Dan. And I know that part of our mandate is that we are separate from the government. How do you guys see that digital infrastructure investment come into play? So we have the best capital markets in the world, at the same time that doesn't need gaps.
So I guess I would make you raised some really important points, but I think the core issue that I would focus on is the decision to improve the payment system is entirely within the mandate of the Fed. And the Fed took a complete dirt nap on it for decades. And it did so in large part by this giant explosion. And this is the hidden elephant in the room. And with all due respect to Professor Herring, who laid out a really coherent argument about geography, I want to talk about product. Because a $35 overdraft is a loan or a fee. That is not a geographic question. The 14,000 check cashers that have sprouted out around this country are providing a real value in solving a real problem, which is Friday is November 29th. I get paid. How do I make my automatic credits from my bills that are all going to be auto-deducted on the 1st? And there are investment bankers who have gotten seven-figure bonuses for commercial bankers, seven-figure bonuses for figuring out how to order those to maximize the overdraft at their institution, and I need to have my funds in there. And for 20 bucks, a state licensed check casher can provide me that money to physically take to my bank. Otherwise, it's $35 per. So it's a deeply rational situation. It could be easily solved by technology. It took the Bank of England 18 months in 2007-8. If you have any questions how they do it, ask Paul Tucker, right? Mexico, the European Central Bank, which is a really complicated set of problems between all of these different, they have to, 17 factorial central banks to coordinate with the right. You think we have a legacy system going back to the 19th century. Wait till you look at some of these countries who are 1,000 years old. They figured this out. You are correct. The federal government last gave the Federal Reserve 2 mandates on this. One, something I was part of writing, which was the Check 21 Act, which was a response to 9/11, in which the paper flying position of our checks, which reiterated the legal authority given under the Expedited Funds Availability Act to make payments available to consumers as quickly as technology allows. Today, we're down to 3 days. That is not as quickly as technology allows. Nobody in this room has been hurt by that. That's the core. The people that are going to the check casher, the people that are going to the payday lender, right? And point of fact, a lot of people here have been helped by that because they didn't have to close unprofitable banks. Because everybody's loss is somebody else's gain. There's a little bit of a zero sum. Now, there's more than that. There's a technology aspect. So, and that's why it stunned me in this whole debate about, the big value about Fed whenever coming in 2023, 2024 is 3 or 4 more years of overdrafts. That's what this whole thing, in my opinion, is about. I'm going to close with one thing about where the federal government has delayed action that I think the central bank and bank regulators can't get around, which is identity, right? One of my favorite, 38% of Americans have federal picture photo identification in the form of a passport. 62% of Americans rely exclusively on state photo identification in the form of a driver's license. But just, again, this kind of bubble question, right? How many people here don't have a passport? How many people here don't know anyone who doesn't have a passport? 62% of Americans don't have one. So identification, which is one of the multiple layers in a stack to create financial technology, and a lot of these payments and messaging innovations Gary, I think, talked about, are actually hampered or trying to solve identification. And the federal government is not going to be a player, and we need to rely on this state-based identification system, and I don't see that changing. But on the payments, all of the legal mandate is completely out there if it wanted to be used. It just has been chosen not to be.
I think you raise a really, if I understood the question, a really important point about the infrastructure we have to support a digital economy. And so this is something that I think about, representing 50 states with a lot of rural areas, is access. And I attend a lot of fintech conferences and everything, it's like a switch that can turn on and all of a sudden we go digital, when that's not necessarily true for all Americans. Maybe I hope we'll be there sooner rather than later. I'm sure are solutions to this, but we're not there, and there's the possibility of leaving even more people behind if we have this transition. There was some good research out of the UK on this, and the FDIC's done research on the usage of banks and branches. It is not a light switch, and there's the possibility of leaving people behind in terms of basic services, and certainly the lending infrastructure. If there's a disintermediation of those who do this relationship lending that really sustains a lot of small business, that could be displaced in a very disruptive way.
Other questions from the audience?
I had a question for John Ryan. Yesterday we talked about sandboxes, and we highlighted the fact, one of the speakers highlighted the fact that there are 3 states that have issued regulatory sandboxes. Just curious whether or not that debate is live with your organization.
So, it's lively. So I don't see, I don't think we've really effectively defined the sandbox and its purpose and what it does and the way some of these are structured. I have some skepticism. I think the principle behind it, and if you look at, Richard referenced the UK model, they were solving for a particular problem, a consolidation of their industry. They realized as a result of the financial crisis that actually the consolidation they needed to facilitate to protect the taxpayer was endangering the consumer, that they were lacking, and they acknowledged this. And so they were facilitating new, feeling they have to shepherd and handhold new entrants into the marketplace. I don't think we have exactly that same problem in the US, so I think we need to clearly define the problem we're solving for. I was meeting with the CFPB yesterday, and Paul Watkins, who heads their effort, they're kind of redefining some sandbox, other ways of doing this. We do need to have a conversation and be able to, I think our strategy, so we've had some good intentions, I think our strategy and what we're trying to achieve is just not there yet as a financial system, and we need to clearly define some of those goals. Open to innovation, it can't be a backdoor deregulation. It needs to establish basic consumer protections that we're trying to achieve, and if there are different ways of getting there, we should be open to learning about that, but I think there's some appropriate skepticism.
So,
Yep.
So I need to thank the panelists for your thoughtful things. I think the conclusion from this is that there are a number of issues, a number of things. The regulatory structure is not perfect, but there are a lot of thoughtful issues to be considered, not only the size of access, diversity, inclusion, but how to make the system fairer for more. And those things should be on the table. So thank you all again.